So with that, I want to go into a quick comment about what has kind of evolved into a pretty good opportunity. Uh, ARM loans are starting to get a little bit more attention in the industry, in the mortgage industry, and in general in the financial industry. I mean, frankly, I haven't originated an ARM loan in about 5 years. ARM loans have not been a major part of the mortgage industry for quite some time. The rates on them, the rates on them simply haven't been that good when you compare it to 30-year fixed, even with the increase in the fixed rates that we've seen in the last year or two, or a couple of years. But there's been a recent shift in market conditions that are creating an opportunity. Now, that opportunity, oddly enough, is specifically associated with the FHA 5-1 ARM. So that's what I want to tell you about a little bit. FHA ARMs right now can offer rates a half to 1% below a 30-year fixed. Conventional ARM loans, not so much. The spread between a conventional ARM start rate and a conventional 30-year fix is still pretty narrow. But FHA, it's getting pretty wide just based on what's going on in the financial markets. And the thing about the 5-1 ARM, let me explain what that means and how it works. An FHA 5-1 ARM, what that means is you're going to get a initial interest rate that's going to be fixed for 5 years. At the end of 5 years, the one in that description, 5-1, the loan will then adjust annually every year, once a year. So a 5-1 ARM fixed for 5 years, then it adjusts annually every year, once a year for the additional 25 years to get to the full 30-year term. Now, a conventional ARM, just as a point of comparison, they work a little bit differently. Conventional ARMs, the most common ones that are offered today are fixed for 5, 7, or 10 years. So that's good. I mean, those are part of the reason we call them hybrid or fixed ARMs, because you have a good fixed period that can be as much as 10 years. But with a conventional ARM, the standard core product that's available today, they adjust after the fixed period on a semi-annual basis every 6 months, not every year. I would call that a less desirable adjustment schedule than the 5-1 ARM that the FHA offers. More frequent adjustment intervals means a potential of more frequently seeing the rate go up in a rising interest rate market. But of course, at the same time, if we have a lower interest rate market trending, then you maybe get to take advantage of that more often. Now, the key thing to look at when you're looking at these ARMs, and this is where I think the FHA ARM has a great advantage over conventional ARMs, are the caps. Okay. Now, the caps with the 5-1 FHA ARM, they are what we call 1-1-5. Okay. 1% the first adjustment. So you have the loan for 5 years, and then in start of year 6, you can have an adjustment in your interest rate, but based on the index, which FHA loans are tied to the 1-year constant maturity treasury index, plus a margin added to it. That sets the rate for the 6th year. But if it causes an increase in your fixed 5-year fixed rate period, you're capped on that increase at only 1%. So you cannot go higher than 1% above your start rate, even if the index plus margin is higher than that. And then each subsequent adjustment is also 1 year, again, for the entire remaining 25-year life of the loan. And then it has a 5% life cap, meaning if you start at, say, 5.5 on a 5-1 ARM, your life cap means you're not going to ever be higher than 10.5. Now, a conventional ARM, the caps are different and not as good. A conventional ARM, the standard caps are 5-1-5. And here's the scary part. Let's say you get a conventional ARM with a 7-year fixed period. Well, that's good. You get an extra couple of years. But then when it adjusts in year 8, if the index plus margin, now with the conventional ARM, the index is the secured overnight financing rate, what we call SOFR. That's actually, and then a margin is added to that. If you're fixed for 7 years and then the index has to be, or the rate has to be adjusted in year 8 based on the SOFR plus the margin, the increase in that 8th year can be as high as 5% over your start rate. That's huge, right? And then after that 8th year, I shouldn't say the 8th year, the first adjustment in beginning of year 8, the adjustment is going to occur. If there's an increase required, it's going to be capped at up to a 5% increase, which is substantial. And then it's going to adjust again in 6 more months. And then those adjustments starting after that year 8, first 6 months, then every 6-month interval after that, it is a 1% adjustment cap, and you do still have the same 5% life cap. Although again, conventional arms typically are going to start more like the higher 5s and the 6s, so your life cap's probably going to be 11% plus. Now here's the key difference with the FHA 5/1 ARM and why I think it's a huge opportunity for those borrowers who need a FHA loan, whether it be for qualifying purposes or maybe as a rate play. The conventional the FHA 5/1 ARM qualifies at the start rate, at the note rate. That is not the case with a conventional ARM loan. With a conventional ARM loan, you are not going to qualify at the start rate. You're going to qualify at the fully indexed rate. That means the index plus margin, or the note rate plus 2%, whichever is higher, except if you take a 7/6 or a 10/6 ARM, which of course those have a higher start rate than a 5/6 ARM. So that's a key difference. That's why if I'm talking to an FHA buyer and we're quoting them 6%, 5 and 7/8, and we're running into a debt ratio problem, a 5/1 ARM can be very helpful, because we do get to qualify at that lower start rate. And if the lower start rate is, say, 5 1/8 versus a 30-year fixed FHA at 6, that can make a very significant difference in the borrower's ability to qualify. So I just want to bring this to people's attention that the 5/1 ARM right now is a great opportunity from a rate perspective. And so I'm spending more time now when I'm pre-qualifying buyers who need FHA or want FHA, bring this to their attention so they understand the rate opportunity. Now, an ARM loan, of course, has some risks involved. What happens to your rate and payment when the adjustments start after that 5-year period? What I would say to that is a couple of things. Number one, in a lot of cases, the 5/1 ARM or any conventional or FHA ARM is going to work best or be suited best for a borrower who maybe has a pretty good idea they're not going to need the loan or keep the loan or the house beyond that fixed period. But even if they choose to keep it past that fixed period, you want to understand that these loans are not designed to automatically go up. They can go down. And we have seen in certain environments, like earlier in this decade, the 2020, 2021, those who had hung on to ARM loans that they got maybe 5 or 6 or 8 years before that actually saw their rates drop because of rates in general falling. So again, I want to bring this to everyone's attention. The 5/1 ARM is becoming, I think, a very good product alternative to look at if you're rate sensitive and if you need it for qualifying purposes. So if you have any questions about this product, if you'd like to get a worksheet on this product, contact me. I'd be happy to put some numbers together for you and get them to you so you can evaluate this along with your other mortgage program options to consider, especially if you're buying a home.